Hey, welcome back. Lithium right now is at relatively low prices in the wake of a potential recovery in China plus the US and EU when it comes to demand for EVs. One of you mentioned a very interesting lithium miner a few weeks ago, Pilbara Minerals. You'll see in a bit why this company may have even more potential to develop than Arcadium, potentially being a very likely acquisition target. They had and still have some significant project improvements because this company already produces, with the first production at the new project expected in March and full production ramp up in September this year. This would bring the total production capacity to around 1 million tons per year, making it one of the biggest concentrate mines on the planet. However, following a pre-feasibility study, they saw that this mine has resources and potential to improve to more than 2 million tons per year, potentially making it the largest concentrate mine on the planet so far. They are now running a feasibility study to see how they can achieve it that should be ready in December this year. They'll provide a roadmap probably in December. So basically doubling the production from 2023 to 25 and then having the potential to double it again, plus more that I'll talk about in a bit. This year is expected to significantly improve the growth of EVs, meaning a potentially much higher demand for lithium. A reason is probably China's recent shift in policy towards what they did during the financial crisis, lowering the rates and other monetary and fiscal stimulus that would boost the demand in the country, including for EVs, both from the customers and the producers. At the same time, a majority of lithium companies, including this one, lower the production or scale back on their investments, which can be very good for the price. Now, there are a few advantages with this company in particular. They have one of the largest lithium projects, 100% owned in the Pilbara, so they are literally next to Rio Tinto, BHP and Fortescue, three of the top 4 iron miners who make a ton of money. Rio has recently bought Arcadium Lithium, so seeing someone buy Pilbara Minerals shouldn't be a surprise. Why this is even more likely now is because iron depends a lot on China and the country just adopted a shift in policy that should boost the economy. Iron consumption and steel output are pretty much tied to the country's economy, meaning that the literal neighbors of this company that might buy it will maybe make even more money. They still make a ton of money and are trading at relatively strong valuations, so they have both the money and the stock price to fund an acquisition however they want. With an improvement in demand from China and potentially the price of iron ore, they would be in an amazing position that might trigger another acquisition frenzy. And as I mentioned in this video, all these companies actually develop other commodities on top of iron, including lithium. Plus, the Pilbara is close to China, which is the leader in EVs, and they already have all the logistics needed to sell there, and we can see some Chinese influences, visits and stuff to and from the company. Based on the outlook for this fiscal year, which they cut, the production capacity should be around 30% higher than in 2023, meaning another billion in cash flows back then. At peak lithium prices after the full September ramp up, this company will have the potential to make even more than the current market cap per year. But that's extremely high prices, so let's say a quarter of that, so around 20k per ton, would lead to around 700 million US dollars, which is still very good. They are in excellent financial health, with the cash alone covering all the liabilities, no significant debt maturities and the debt being spread over the medium and long term. The equity, everything is in Australian dollars by the way, is almost exactly half of the market cap, which isn't really the best. Arcadium was trading even below a ratio of 1 before it was bought by Rio Tinto, so these assets aren't really the cheapest, but still a very good shape overall. As a parenthesis, it's kind of tough to properly value a lithium project when the price jumps up and down so much. You know, it can be significantly more profitable than gold if it jumps to 20, 30, 40,000 or almost worthless if it drops to 5. And it's not only a matter of lithium prices, but also how much a buyer is willing to pay at a certain time. For a reference, the number 1 and 2 lithium producers are at a ratio of around 1 and 2. They are so different because SQM is much more than just a lithium producer. They have fertilizers, plant nutrition and other commodities which aren't the cheapest right now. Plus the asset quality with generally low production costs and competitive advantages. Anyway, they paid a huge double-digit dividend before, but so far nothing has been announced as everything is dropping. This is normal for lithium and many other commodities, especially when the company is investing so much and basically 40x'd the capex. They target 20-30% of the free cash flow as dividends, focusing the rest on debt reduction, investments, and special dividends if the money allows. But when capex normalize, production increases, and maybe so does the price of lithium, this can pay a solid dividend for longer. It's a relatively young company in terms of production, so I wouldn't expect huge dividends now when they focus on developing. To get an idea, in comparison, this company produces around 50-60% of SQM's and Albemarle's lithium today when converting the concentrate into lithium carbonate equivalent. That's definitely not bad, and given the current prices, this has real potential to be an acquisition target. But they are actually the buyer right now, recently purchasing Latin Resources, a company with a lithium project in Brazil that can be developed into a top 10 hard rock lithium operation outside of Africa. So not only do they have a tier 1 mine in Australia that can be developed into potentially the number 1, but they also bought another tier 1 mine that they can develop at the same time. So this company's potential to grow is actually even bigger than Arcadium's, which for a reference was huge, something like a 3-4x in production. They are also diversifying mid and downstream with a couple of projects and a chemical facility in South Korea. It's nothing huge, but they want to become a fully integrated battery material supplier. That would make them pretty similar to Arcadium, and if I remember correctly, both Livent and ALTM had vertically integrated operations in the supply chain. So even more reasons now for a company like Rio, BHP and the rest to buy this. They are mentioning how the current price is barely covering around half of the supply cost curve, meaning that the difference of around 30% needed to meet the demand is unsustainable, which of course can't remain like that. They also placed the project in maintenance because of it, reducing the production by around 10%. And we can call this a good indicator of a downside. You know, companies closing mines, cutting production, everything falling for everyone. We saw pretty much every other lithium company scale back on its investments and even production in some cases more and more often recently. This will then lower the supply, and if China's or the global economy improves and the demand for EVs and lithium recovers, this can be huge for the price of the commodity. This is the normal commodity cycle, although this one in particular has been much more volatile than others for a few reasons. Anyway, there is already a massive supply gap expected by the end of the decade, so scaling back on this future supply can make it even worse. But at the same time, lithium may not be the commodity of choice for batteries in the future. It's a very R&D intensive industry, so you have to balance the risk and reward. Or maybe there won't be that much demand, but at the same time, if there is, replacing lithium with another technology can take much more than half a decade. On the one hand, it has massive potential, but on the other, it can be an okay but not that important commodity. This is why the lower the cost of production, the better, because it's a clear margin of safety. The valuation will be pretty tough to do. We don't really know what they can make throughout the cycle, and they are developing so much that it's pretty hard to estimate. I think 2024 is probably a good indicator of a low to average year, so we can begin from that. In a negative scenario, if they can make, let's say 150 million during the bad times to adjust for the 1 million production milestone next year, that's 93 million USD. I'll convert everything in US dollars by the way, so it's easier for everyone. For a ratio of 7, to show some confidence in their potential to develop and great financial position, that's a market cap of 651 million. That's a price of 0.21, so actually very similar to the level from 2020 when we saw lower lithium prices. But then the assets plus the new Brazilian project would be very undervalued, so it would definitely be very interesting. If they can double the production from this level, we can just 2x everything and get a rough idea. So still has potential to fall significantly like any other lithium company. But commodities are cyclical and we already see production and investment cuts, which is a great sign that will have an effect on the future supply. In an average scenario with lithium prices around 15k, let's say they get to around 370 million adjusted. For a ratio of 8, that's a market cap of 2.96 billion, meaning a price of 0.98, so still below the current level. Again, double that much plus the potential from Brazil and we get to a pretty good long-term potential. And it's not even that much compared to SQM and Albemarle today, still being almost half of them. Again, China's policy change can be enough to spark a recovery in the EV market, so definitely possible. Now, in a good good scenario during the upcycle, let's say lithium gets to 25,000. Adjusting it, they can probably make around 500-600 million. For a ratio of 8, that's a market cap of 4 to 4.8 billion, so around 1.3 to 1.6 per share. That's basically the current price, but the market is obviously pricing in the company's massive potential. Double this again and we get to a market cap of 8 to 9.6 billion for a price of roughly 2.6 to 3.2 and over a 2x. Add the project in Brazil and let's say this would be a potential 3x. Not to mention that lithium has potential to get much higher again, so there will always be a chance to become a proper multi-bagger. So the company itself has potential, but the stock not that much from this price. Sure, it can easily go up 50, 70, 100% if there is a recovery in lithium tomorrow, but the real potential would come when buying this during the downside. Maybe waiting for another delay or some issues or production cuts while the potential remains the same, and then we can see this really shine. The issue, I guess, is trying to balance how much to wait and basically how greedy to be for a better reward and margin of safety while not having a Chinese company or an iron giant buy this before I can, again. Keep in mind that Arcadium was getting to a point where you were able to get massive discounts for huge projects. This isn't the case yet for Pilbara. Overall, this is definitely interesting. If you want to get an update and see when I buy them, if I do, check out the Patreon link below. Again, the way I want to get exposure to lithium is through a healthy company with potential that can survive even in a time like today, and Pilbara Minerals looks like it might be that. I'll keep an eye on them and might open a position relatively soon. So maybe not the cheapest assets compared to Arcadium or Albemarle, but the potential is definitely huge. In let's say half a decade to a decade, this company can more than quadruple the production from a few years ago. If we then see lithium get back to even a quarter of what it was during the peak, we know that this can make a ton of money. Don't forget that they also bought a project in Brazil that can be developed at the same time as the one in Australia and can always get even more. The dividend, in my opinion, wasn't such a smart move, but buying the project in Brazil during tough times is definitely a huge plus for me. And having so much cash and still producing money is a big advantage. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.